As a quick refresher from the last segment, we'll look at the stock valuation first. Remember, when the book uses valuation, you can really think of that as the price. Right? What's the value of something? It's whatever you're willing to pay for it. So in the formulas you see in the book, instead of the P that I have here, you'll see a V. And a V subscript CS for value of common stock. But to keep things simple, we'll just talk about the price or the willingness to pay. So the growth factor is the profits that you're going to keep, the percent of your retained earnings that you're going to keep into the business. That will be your growth. The price of a stock, or the value of a share of stock, is the dividend divided by the required rate of return, investors' required rate of return, minus the growth factor. Right? So that's that amount that you're going to get in terms of price. Now, we probably, like bonds, want to know what the expected rate of return of a share of stock is. If you buy a share of stock, you want to know, what am I going to get? With a bond, you can calculate the yield to maturity. What's the present value, the rate of return that you're getting of all those future payments? Well, it's pretty easy for preferred stock. The rate of return is just equal to the dividend divided by the price. We just rewrote the annuity, the perpetuity equation around and solved for R. So the expected rate of return is the dividend divided by the price. All right. Now, that is really what we call the yield on a stock. Right? The dividend divided by the price is the simple yield on the stock. Remember, the interest rate divided by the price of a bond is the yield on a bond. Well, stocks don't pay interest, but they do pay dividends. So the dividend divided by the price is the yield on a stock. So basically, your expected rate of return on a preferred stock is just the stock's yield. On common stock, you would look at it's a little more interesting because there's a growth factor, right? There's not a constant rate of dividends. So it's the yield plus the growth factor. So it's a relatively simple thing. So if you have a stock that's paying 4% in dividends, and the growth factor is 2%, then 4% plus 2% is your expected rate of return, 6%. Right? So it's your dividend yield, how much you're getting from the stock currently in dividends, what percent, plus the growth factor, which intuitively kind of makes sense, I hope. Let's take a look at equity returns. So you invest in equities. How do you get your money back? Well, the change in price of stock, if you make a profit, is called a capital gain. Capital gains are very important. Capital gains are important because they're taxed at a different rate than ordinary income. Any asset that you sell for a profit incurs a capital gain. If you sell it for a loss, it's a capital loss. So you get money by stocks prices going up, which is what we commonly think about. But you also get returns from the dividends. And you can see that in the calculation for the valuation of a common stock. Right? The price is definitely influenced by the dividends. Talked earlier, many companies pay no dividends. Why? Because they expect to grow. They're taking that money and profits and plowing it back into the company. Apple did this initially. Microsoft did this initially. Almost all small startups do this. But at some point, you run out of places to invest. Doesn't look like Amazon's running out of any places anytime soon, so they're not paying dividends and just keep finding new places to invest. Now, most of the returns come from capital gains. You can see that in the S&P 500. But the dividend yield was still about 2%. For investors, expected rate of return is what matters. as it says on the chart. What we mean here is that I care about what's going to happen in the future, not what happened in the past, not what things look like now, right? Yesterday, the stock market tanked. Okay, that was yesterday. All I care about is what's going to happen tomorrow and the next day and the next day and the next day. We introduced one, if you had me for intro to business, we called that sunk costs are sunk. What happened in the past is the past. The value of a stock really reflects future value, people's expectations of the future. So we talked about what kind of company pays no dividends. Those that expect to grow. Right? If a company doesn't pay dividends, it doesn't mean it's in trouble. It means it's reinvesting its earnings. Who would buy, though, a company, a dividend-paying stock? Why would you want dividends? Why not just get the capital gains as the stock grows? Well, some people want regular streams of income. There's a category of stocks that sometimes are called the widows and orphans stocks. It's because people buy these so that they get income to live off of. Some stocks pay 4 or 5% in terms of a yield, and you get current income. Some people want that. Some people want a mixture. Why would you want non-dividend paying stocks? Well, think about it. You don't want the income now. You don't pay income tax now. You'll wait till later when the stock price goes up and make it in capital gains. So it's kind of, do I want the money now? Dividend paying stocks. Do I want the money later? Non-dividend paying stocks. Now, let's compare the two stocks. One pays dividends, the other doesn't. After 10 years, which one of those, let's suppose they both start out at $10 a share. Which stock price goes up more after 10 years? Well, probably the one that doesn't pay dividends. Right? It's reinvesting. The company is growing. Right? So its stock price is up more than the one that pays dividends. Does that mean it's a better stock than the other that doesn't pay dividends? Not necessarily, right? Because the one that pays dividends, the shareholders are getting cash all along. Right? So for 10 years, they're getting dividends. So we really need to take a look at the present value of those cash flows to determine which is the winner or the loser. All right, so these are the concepts. In the next segment, we'll take a look at how we can do some simple calculations with these in Excel.